This is Professor Hazara, and this is the final of the videos on this final prep problem. In the last video, in this prep problem, we had already done all the first two videos. We did the preliminary calculations, the consolidation calculations, and then the third video we did the consolidation entries. Now we're just going to finish the consolidation. Of course, on the test, I make you do these. I don't pre-place these for you. You got to learn how to do these from the start. Okay, but I'll just go ahead and finish these. So the first one is to debit sales and credit cost of goods sold to recognize income. That's entry number 1. This is on the ending inventory. To reduce that, basically backs out your parents' sales. Entry number 2 is you're going to debit cost of goods sold for the ending inventory gross profit. Go right here. You're going to credit inventory to write it down. Your ending inventory had gross profit that shouldn't be there. That's entry number 2. $20. Okay, in entry number 3, we're going to debit the investment account because this is for beginning inventory, and it was beginning inventory had not been sold as the beginning of this year. Outside third party, so it was sitting in your investment account. We're going to clear that out, and we're going to credit cost of goods sold in entry number 3 to recognize that the credit cost of goods sold reduces the expense, which increases your income. It means you recognize that gross profit because it's been sold from outside third party. In entry number 4, I believe, is for the land. So we'll go down here for the land, and we've got to write down the land from 1,500 to 1,000. So we'll credit that for 500. And we'll debit the investment account for 500 because that transfer took place before this year. So it was still sitting in your investment account and will be sitting in your investment account until you sold it to an outside third party. There's the debit right there. Okay, and the final thing is gain on sale of equipment. There had been a gain on sale of equipment this year, so it was sitting on the subs books. That was upstream. So that, and then we've got to write the equipment down because it had been basically falsely written up. Okay, so we've got credit to the equipment account there in entry number 5 for 800. Okay, and then we've got some excess depreciation, so we're going to credit depreciation expense in entry number 6 for 200, and the equipment account is recorded at net, so we will credit that. If it weren't written net, we'd crediting accumulated depreciation, but the equipment account is at net for 200. Okay, so I'm going to go ahead and sort of check my debits and credits. They equal so far, so that's good. Okay, so we've got entries, the regular entries now. So in entry 7, we will eliminate the income from sub, which is eliminating the wrong count there. We're going to debit income from sub for 790. We'll take out the parent share, the controlling interest share of dividends, which is 90, and we'll credit the investment account for the difference, which is 700. That takes you back to your beginning balance. Let's check our totals again. Okay, looks good. Okay, now we're going to take out the beginning investment balance. So we'll always start that with the debit to common stock in entry number 8. For 5,000. Then, as I've always keep saying, take out the retained earnings. Your beginning retained earnings is only on your statement of retained earnings. The ending retained earnings will be on your balance sheet. That's accounting 201. Okay? And then we've got to write up our goodwill. So we'll debit goodwill for the 5667 or whatever it is. Okay, and then we'll debit, we need to write up building for its correct beginning of the year write-up balance, which is 1,500. And then finally, we're going to take out the beginning investment balance, which is 14,000 and some change, 450, not finally. And then our non-controlling interest, we'll establish our beginning non-controlling interest of 1617. And so finally, we've just got we only had one undervalued item, which is a building, so we've got to depreciate that for the year. I think it's 500 per year. So we're going to credit building for 5 and debit depreciation expense for 5. And the final entry in the big 4 is to update our non-controlling interest going all the way back up here from 1617 to 1697. So we're going to debit the non-controlling interest net income. We're going to debit the non-controlling interest net income, which, by the way, is right here in entry number 10. That's what NCI stands for, non-controlling interest income. We're going to credit their share of the dividends for 10. And the difference is your update to your non-controlling interest, and that is for 80, whatever it is. 90 minus 10 gives you 80. Okay, and notice that our totals add up, so we should be fine. We'll just finish the consolidation here. Okay, so your total sales are 26 plus 11 minus 15. So total sales are 37,000. Checking against my sheet here. I could just leave it there, but just to finish this up, you wipe off both the gain, which shouldn't be there, and you wipe off the income from sub, which shouldn't be there, both with debits. Okay, your cost of goods sold is negative 15 plus a negative 5 minus 120, because and you're adding to a negative there, plus whatever that number is, and plus that number. Your final cost of goods sold is negative 1850. So you got a negative 37 plus 2,000 minus 500 plus whatever this number is. You got a negative 6,000 is your depreciation expense. Your other expenses don't have any adjustments. And then always treat your non-controlling interest, make that a negative. And so your income should be 3810. Let me check this out. Minus that. Minus that. Minus that. It's right here. This should be 26 plus 11 minus 15. Could be 35.5. So notice that your income should equal your parents' income, and it moves down there into the net income. Okay, your beginning retained earnings is 12,375 plus 4,000 minus 4,000 gives you 12,37 for beginning retained earnings. The income's already there. The dividends will end up as the parent's dividend, so it's that minus that. Plus that. Let's see if I get it right. Yep, minus 3,000. Okay, so 1237 minus 3810 plus 3 gives you retained earnings of 185. And notice that the parent's statement of retained earnings is exactly the same as the consolidated statement of retained earnings. And then we're going to take this down. I'm going to make these 0 just so that you see me add them up here. Retained earnings was taken down. Okay, and then so the only thing left is our balance sheet. Our balance sheet is going to be for cash is 2720. These didn't have any adjustments, so it's no big deal. 3180. inventory is 7,000 minus 120 gives you 6880. Your buildings are 4,500, and that includes the net 1,000, which would be the 2 years of, or your line is 4,500, and the building is going to include 2 years of, going to next year you have 2 years of undepreciated building left. So anyway, so we're going to have $15,000 plus 4,000 plus 1,500 minus 500. Your buildings are 20,000. Equipment is 14,000 plus 200 minus whatever that number is underneath there. Gives you 800, 13,400. That's correct. Your investment account is 14,650 plus 100 plus 500 minus 700 minus 1,445, which is 0, which is what it should be. And your goodwill, people forget this, is 5,667. So your total assets are equal to the sum of all these numbers here, which is 53646.57. That is correct. Now we will finish with our liabilities. This is the easiest part. Liabilities, accounts payable 3910. Other liabilities 11,555. Retained earnings is 26 plus 5 minus 5. Gives you 26,000, which is equal to the parent's retained earnings. Non-controlling interest is the beginning non-controlling interest plus the update, which is 80. And you see that the two totals are the same there. Okay, so that finishes this example. It's in 4 different videos. I'll see if I can post this sheet too, so that should help you. But keep in mind, there's 2 things I want you to keep in mind as we wrap this thing up. And I emphasized this in the first video. On this type of transfer, intercompany equipment transfer, if you have a gain, you have excess depreciation. If you have loss, you have total depreciation, so you'll be adding it back. So what we're doing here is when you get down here, this entry will be reversed. It'll be adding back depreciation, and everything will be the opposite. In the income calculation, well, you don't have it here. Yes, you do. The income calculation, you'll add back the loss and subtract out the excess depreciation. Okay, and the other thing is keep in mind the intercompany transfers that took place before this year. In this case, it was that item took place before the year 2019, and the land transfer that took place before this year. And so those are the only 2 items which will be sitting in your beginning investment account. Those 2 items right there with respect to intercompany transfers. Anyway, I'll stop there and post this video.